Imagine the government shows up to your retirement party, uninvited, grabs a plate and says, "We'll be taking some of that." That's basically what a required minimum distribution is. And yes, it's completely legal. Here's the deal. When you spend decades stuffing money into accounts like a traditional IRA or a 401k, the IRS has been very patient, letting that money grow without taxing it. But once you hit a certain age, they come knocking and say, "Okay, time to pay up." For a long time, that magic age was 70 and a half, which felt like the IRS just picked a number out of a hat. Thanks to some updated rules, that age is now 73 for most people, and it's headed towards 75 eventually, so at least they're giving you a little more runway. Every year after that age, you are required, not suggested, not encouraged, required, to pull out a specific chunk of money from those accounts. The amount is calculated based on your account balance and something called a life expectancy factor, which is exactly as morbid as it sounds. Think of it like the government saying, "We let you defer these taxes for 30 years, and we'd really like to collect before, the whole situation wraps up." It's not personal, it's just math. And also, definitely, a little personal. Now here's where people get tripped up. You don't get to just leave that money sitting there because you feel rich enough without it. Without it, if you skip your RMD, the penalty used to be a whopping 50% of whatever you were supposed to take out. And even after recent reforms, it's still 25%, which is a very expensive mistake for doing absolutely nothing. The money you pull out gets added to your regular income for that year, which means it gets taxed just like your paycheck used to be. So if you're not careful, a big RMD could bump you into a higher tax bracket, make more of your Social Security taxable, or even increase your Medicare premiums. It's like a financial butterfly effect in the worst way. This is where planning ahead becomes your superpower, because you don't just have to sit there and let it happen to you. Some people do something called a Roth conversion earlier in retirement, moving money into a Roth IRA, which doesn't have RMDs, so future you has more flexibility. Another move smart retirees make is called a qualified charitable distribution, which lets you send up to $100,000 a year directly from your IRA to a charity tax-free. You still satisfy your RMD requirement, but that money never hits your taxable income. Honestly, it's one of the few times the tax code accidentally became kind of wholesome. If you have multiple IRAs, you can actually total up all your RMDs and take the full amount from just one account, which gives you some control over which investments you sell. But with 401ks, each one has its own separate RMD, so you can't mix and match those. The rules love to keep you on your toes. A lot of people don't even realize they have an RMD coming, because they've had the same retirement account since the 90s and kind of forgot it existed, which is both relatable and a little financially terrifying. Setting up automatic withdrawals with your account custodian is one of the simplest ways to make sure you never miss a deadline. There's also something called the still working exception, where if you're still employed and participating in your current employer's 401k, you might be able to delay that account's RMD until you actually retire. That rule doesn't apply to IRAs though, so don't get too comfortable. The first RMD is a special case because you actually get until April 1st of the year after you turn 73 to take it, which sounds like a gift but can backfire badly. If you wait until that April deadline, you'll also have to take your second RMD by December 31st of the same year, doubling up your taxable income in one shot. The big takeaway here is that RMDs aren't just a tax nuisance. They're a signal that you need a real strategy for how money flows out of your retirement accounts, not just how it went in. Pretending they don't exist is how people end up shocked at tax time, wondering why their refund turned into a bill. If you want to go deeper on retirement income planning and how to navigate all of this without losing your mind or your money, are you curious about what our company can do for you? Go ahead and check out the links in the description.